Hello folks, I'm Bob Bruce of Integrity Wealth Consulting with our educational economic update for March 2017. In this month's video, we'll discuss some of the major headlines that influenced markets in February and provide insight into what these developments could mean for you. Please stay tuned at the end of the video for our required disclosure statement. February 2017 was a month filled with record highs in the domestic markets. The S&P 500 and NASDAQ both hit a number of new highs last month, while the Dow went on a record-busting streak. In fact, after reaching 20,000 for the first time ever in January, the Dow hit record highs every trading day between February 9th and 27th. The last time we experienced that sort of record was back in 1987, and this is only the second time it's ever happened in 120 years. Seeing stocks rise like this can be a very exciting experience, but I want to caution you not to get caught up in the euphoria. Just as emotion has no place in investing when the markets are volatile and challenging, the same rule applies when the markets are growing at a great rate. So let's dive deeper and review some of the fundamental data that we learned in February to better understand where the economy now stands. On the labor front last month, it gave us somewhat mixed data. We received the January jobs report, which showed that the economy added far more jobs than experts predicted and continued its 76th straight month of growth. But on the other hand, hourly earnings and labor force participation each increased by only a small margin, while unemployment was also up slightly as more people entered the workforce again. Ultimately, the job data release in February indicates that the labor market is growing, but the pace is still not what people would prefer. Another area where we saw some modest growth was the revised gross domestic product numbers, our GDP, for the fourth quarter of 2016. Each quarter, the Bureau of Economic Analysis calculates the U.S. gross domestic product, which is the total dollar value of everything that people and businesses produced in the United States during that period. This measurement is a critical indicator of our economy's health, so investors and financial analysts watch it very closely. And because the Bureau receives updated data after a quarter ends, they release 3 GDP numbers over the course of 3 months: the advance, preliminary, and final. In February, we received the second or preliminary reading of GDP for quarter 4, 2016. Consensus was the reading would increase to 2.1% from 1.9% in January. But in reality, the reading didn't change and stayed at 1.9%. For comparison, quarter 3 GDP came in at 3.5% growth. Rather than indicating that the economy is slowing down, however, just one aspect of GDP contributed the most to the decreased growth: lower net exports at the end of 2016. Trade is an integral part of our economy, so maintaining a healthy trade balance is key. As the political environment evolves, changes to trade deals could affect this balance and as a result affect our GDP. For now, no one can say what new policies may be on the horizon or if the markets will continue to reach even greater heights. So we'll continue to analyze the data and search for the most thorough view of our economic standing. This perspective is the foundation of our support, and we are here to help you find a clear perspective amid all the different hype that you see in the media. That's it for this month's Educational Economic Update. I'm Bob Bruce. Please remember that nothing we talk about here is a recommendation, and if you'd like to discuss your personal financial situation, please give us a call at 724-940-9060.